with the latest on the corporate front, all the market trends, expert opinion, and sound business advice. It is your unique window into the business world, direct from the heart of China.
Hello and welcome to Biz Today. I'm Zhao Yang in Beijing. Coming up, we will have half an hour of business news and analysis. On today's show, the U.S. Federal Reserve cuts the interest rate by 0.5 percentage point. What's the importance of this first cut in 4 years? And OpenAI is releasing new AI models featuring reasoning abilities. And now let's begin with our top story. The U.S. Federal Reserve has lowered the interest rates by 0.5 percentage point among cooling inflation and a weakening labor market. This is the first rate cut in more than 4 years. Owen Facklow reports.
In any other era, a central bank raising or lowering its benchmark interest rate would be unremarkable beyond stock markets and policymakers. But the U.S. economy has been through extraordinary times. First with the COVID-19 pandemic and the U.S. Central Bank, the Federal Reserve, slashing its main interest rate to zero to ease conditions for consumers to get credit and for businesses to expand. But when pent-up demand began to soar in the wake of that pandemic, inflation started to spiral and the Fed was forced to raise its interest rates to the highest levels for years to drive down inflation. But the Fed has decided that battle is over now, with inflation close to the Fed's 2% target. And the Fed has decided it's time to cut that main interest rate. But the size of that interest rate cut, a full 0.5%, will fuel concerns among some skeptics that the Fed has left it too late to cut that interest rate and is now acting aggressively to drive that rate down. Owen Facklow, CGTN, Washington.
For more on this, join us on the line now are Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, Yan Liang, Professor of Economics, Willamette University, and also Ina Tangen, Senior Fellow at the Taihe Institute. So, yeah, I will start with you. The Federal Reserve has announced its cut of 0.5 percentage point. Before that, a lot of discussions were on whether it would be 25 basis points or 50 basis points. So does this 0.5 percentage point surprise you?
Well, I don't think it's a surprise because, as you mentioned earlier, the views are pretty split. And I think, the people who think that this 50 basis point cut is justifiable, they're looking at the economy where, inflation rate has been tamed to 2.4% as of, August. And unemployment rate is just slightly above 4%, 4.2%. So in a way, it is in a good economy. But at the same time, this current Fed funds rate is way higher than the long-term Fed funds rate projected by the Fed, which is around 2.8%. So the idea is that the Fed needs to return to a more neutral stance to get out of the current very restrictive stance. So that justifying the main cuts. But there are also people who believe, like I mentioned, the economy is doing just fine. There's no urgency to have a big cut. And if you cut too aggressively, it could actually send a signal to the economy that somehow the Fed has, some information about the economy is not going to do well. So that large cut could actually backfire. There are also people who question, if the Fed does cut such a large amount, that simply cater for the financial markets wants. And that, in a way, it's not what the Fed would like to do, right? They don't want to put themselves in the position that they simply answer the call of the Wall Street. So I think, it's not surprising. Both sides have their strong reasons as to why the Fed should cut more or cut less. But now I think it's interesting to know that the Fed does go ahead and cut 50 basis points. But again, I think even with this cut, it doesn't mean the U.S. economy is going to be, out of the woods. We can definitely talk about some of the downside risks and also some of the upside risks. But yeah, it is interesting that this has been materialized 50 basis point cuts.
So Jiahe, do you think this 50 basis points is a surprise?
Well, basically, I don't really think that's a surprise. I mean, the market has been anticipating about this, and we've been talking about this interest rate cut this morning with some other investors, and we just thought we can, basically ignore that because everybody in the market has been anticipating that the Fed will be cutting the interest rate. And the only question is it 25 basis points or 50 or even 75? Nobody knows. But the middle guess, I think, is somewhere between 25 or 50 and a bit more leaning toward the 50 basis points cut, and the Fed just cut that. So, in finance and investment is that if something is known by everybody, then it's not a news and it's not going to affect the market. What is really meaningful to your investment and decisions of traders and investors are those things that nobody knows and nobody has actually expected, or no one has been putting their eyes upon. For example, when we talk about long-term investment, value investment, that's everyone is looking at short-term. 6 months, 1 year, 2 years. But people like Warren Buffett and Peter Lynch, they look for 10 years, 20 years. So they got somewhere that people don't know. But for this interest rate cut, the thing is that I think 90% or 99% of the investors in the market have actually been anticipating this. So it's actually not a surprise. But if the Fed, for example, cut the interest rate by 1%, then that's a big news to the market.
So I know, some analysts said that maybe this was too late to cut the interest rate. So what's your take on that?
Well, it depends on your perspective. Politically, obviously, Biden, Harris would have preferred a rate cut earlier, trying to, spread this idea that they have managed the economy. If you're looking from the financial side, I think I would agree with the analysis. It's very much split in terms of what the news is. Last I checked, the market was down because people, they buy on the sizzle, sell on the steak. And at this point, it's interesting. I agree. You don't know what you don't know, but let's look what we do know. The Fed has said consistently over these last few years that they're not going to cut the rate until they get to 2%. Well, it's at 2.4. Well, hand grenades and horseshoes. It's close, but it's not exactly where they wanted to be. And I think a 50 basis point cut is indicating that they're retreating from their previous position, that they're going to be a little bit more flexible. Obviously, the issues involving over 70% of Americans think that they are living paycheck to paycheck. Inflation is an issue. You start looking at credit card defaults and increases in debt, not only on the national level, but across the board. And it's clear that, while there is a segment of society in the U.S. who are doing just fine and think everything's rosy, the vast majority of people don't agree.
So I know, the rate cut may ease some concerns, but are there still risks remain for the U.S. economy?
Oh, absolutely. What they're concerned about is that they threw the baby out with the bathwater. That they increased interest rates and that they have, in essence, wounded in a very serious way the U.S. economy. Remember, the people who get hit by these interest rates, big businesses to a certain degree, but they're going to survive. A few have gone bankrupt, but that's general economic situation. It's small, medium-sized business enterprises who have had record numbers of bankruptcies and things like that. America, just like China and the rest of the world, is led by its medium and small business enterprises. They're the ones who create the new jobs, have the majority of existing jobs. And I think the Fed is now concerned that they were a little bit too radical in pushing this idea that inflation above all. After all, inflation is not the economy. It's just a symptom of the economy. And now I think they're worried about the patient.
So let's talk about the bigger picture, the outlook on the interest rates, the U.S. economy, and those who are looking for a job in the interest rates to buy a new home. So what do you think are the implications for different sectors, for the stock market, housing sector, the U.S. consumers, and for the business investment?
Right. So I think there are a lot of moving pieces, and I agree with Ina. So there's still a lot of in terms of risks to the economy. So for the housing market, we know that high interest rate typically will depress the housing market because mortgage rates are so high that people cannot afford houses. But what we have seen is, again, because the market has been anticipating rate cuts, so we have seen the mortgage rates have been steadily declining. So, for example, last week, the mortgage rate on 30-year fixed loan has reached only 6.2%, which is a 19-month low. So the question now is, with the further rate cut, again, which is very much anticipated, how much more this is going to stimulate the housing market? And even if there is higher demand, then the question also becomes, will the supply catch up? And so if not, then what would be the implications on the inflation, right? Because the shelter costs are going to rise. We have seen, the single family homes starts actually have jumped just last month in August by 15.8% year on year. So it seems that, the construction is going on, and now we're having, more affordable mortgages. It seems the housing market will turn out to be better. That said, I think, again, there are risks, right? Because when you look at the permits for the future single home building, that has gone up only by 2.8%, which is a decline by, 0.5 percentage points compared to last year. So there's the question about, if the mortgage rate does help to generate more demand, will the supply catch up? So I think, again, there are a lot of different moving pieces, how this rate cut is going to affect the economy. When it comes to long-term investment, I agree that, investors are typically looking long-term, so it may or may not affect them that much with a short-term cut. But that said, I think, in terms of the risks, the biggest risks, of course, is the political risk, right? So we know that whether or not there will be, peaceful transition of power, that is still in the question. And even if that happens, we also have very different, in terms of economic policies, whether or not how much the tariff hikes are going to happen, and how immigration policies are going to change. All of this would have tremendous impact on not only the labor market productivity, but also inflation. So I think the rate cuts, even if the Fed is not behind the curve, there's still many complications in the economy. So I don't think that the Fed can just rest assured, nor I think, does the fiscal agency, the fiscal authority could simply, sort of completely could relax and see how economy evolves. I do think that there are all these different risks that are still out there. Not to mention, of course, the geopolitical tensions. With the recent events, I think that still could elevate risks for the economy.
So, Ina, what are some of the structural problems for the U.S. economy right now? Do you think the U.S. economy has reached a turning point and may tip into recession? Because there are a lot of discussions on whether there will be a soft landing or a possible recession for the U.S. economy.
Well, it goes back to what I was originally saying is did you slow the patient down or did you wound it? If you wound it, it's going to take a bit of time and you can anticipate a recession. I do think that there are real problems. And the number one problem that I see is that the U.S. has lost competitiveness. You start looking at all of the industries that were heavily subsidized, Intel, they had tens of billions of dollars, $3 billion more just in the last few days. They're now withdrawing, despite the offer of tens of billions of dollars from the EU. They're withdrawing their plans to expand there. So, this really strikes at the heart, this idea that you can force jobs back to the U.S., still control inflation, and have a healthy economy. They are at odds with one another, and there has to be some sort of rational way of dealing with it, and it's not going to be tariffs. So to the extent that the U.S. continues on this idea that they can erect trade walls and still have a bustling economy, I would completely disagree.
So, yeah, actually, you mentioned the inflation issue. So what do you think were the core reason for the rise in inflation, and have those been addressed?
Well, I think to some degree, I would say that the initial starting point of inflation has to do with pandemic lockdown disruption of the global supply chain. So it's largely a supply side, I would say, factors, right? Not to mention the Ukraine and Russia conflict. So all of these basically affected the global energy supply. And so that is the initial, I think, trigger of inflation. But I think what happened in the United States, there's also, a lot of these stimulus during the pandemic, the economic impact checks that have sent basically federal government spending to over $5 trillion. And so that provides the demand side without that, commensurate increase in the supply. So that does put some inflationary pressure. And later on, I think we're also seeing, corporations, right? That very large corporations that monopolize the markets in food, in energy, in insurance, in used cars, and all these different sectors with the corporate power, they're able to utilize these supply shocks to raise the prices. So we have been seeing this kinds of, profit-led inflation. When corporations have high costs, they raise the prices. And when the cost goes down, when the supply chain restore, companies don't simply just lower their prices. So I think that really, to a great extent, helped to elongate the inflation despite the restoration of the supply chain. So I think, without really directly confronting, these monopolists and trying to, restore the more competitive market, I think we're not likely to see inflation completely sort of recede. And also we're seeing, right now, a lot of service sector inflation, right? Insurance, medical care, and so on and so forth. That could continue to pose upward pressure on inflation. So I think, again, Fed cuts rates may or may not help really in this case, because it's the corporate power, it's the supply chain, again, the over-dependence on external production, right, with the lack of industrial competitiveness, as Aina mentioned. I think all of this will continue to pose risks as far as inflation is concerned.
And now, actually, the Federal Reserve made a decision to cut the interest rate. So, Jiahe, how will this Fed decision impact the global economy? Could we see expansion in trade or in production?
Yeah, definitely. Because the Fed has been having this very large influence over many economies, for example, Australia, Europe, Western Europe, European Union, Japan, all these economies, many of their central banks actually following the actions of the Federal Reserve. So the cutting of the Federal Reserve of the interest rate by 0.5 percentage point actually means the cutting of interest all over the world with many economies. And that means a lot of consumption will be stimulated because it has been the case in the past that because the interest rate was very high, and it's many investors and consumers actually comparing their investments and consumption behaviors with the interest rates. They say, okay, I'm getting this high interest rate here, so why do I buy stocks? Why do I invest in startup companies? Why do I consume? I just save all the money, and they promise me a very high return. So that's why when the Fed was holding the high interest rates, they were actually hurting the economy while they are trying to control inflation. So while the inflation is now under control by a pretty large extent, well, not fully compared with what China is having, inflation rate below 1%, but the inflation right now in the U.S. is now partly under control. So they are pretty eager to lower the interest rate so that the economy can actually move upwards. So this is definitely a pretty good news for the global economy based on itself. But there are still many challenges for the global economy, which so it's not a promised growth only because the Fed has been cutting the interest rate. But we can only say that the cutting interest rate is a good factor for the global economy.
And Jiahe, you are an experienced investor. So how will that, impact the international capital flow trend, do you think?
Well, when we look at the global capital market, that's the same thing happening with all the investors and consumers, is that people are comparing their investment returns with the high interest rate that is offered by central banks, led by the Federal Reserve, but also the European Central Bank, Japanese Central Bank, all these central banks. So it's that when investors, for example, they were talking about investment targets, they say, okay, we need a very low P/E ratio and very high dividend yield because otherwise we can buy the bonds. You have seen that people like Warren Buffett, he has been buying a lot of bonds and saving cash and sold a lot of stocks, basically because the cash and bonds were able to offer him a very high return. And now the cutting of the interest rate means that the fund will be chasing the stocks in the market, especially those that can offer a high interest rate, which is a dividend yield. For example, if your stock offers like 6 or 7% dividend yield, and it was in the past the Fed were offering something like 3 or 4%, and you say, okay, that's not much difference. But when the Fed is cutting the interest rate, investors will come over and say, okay, the high dividend yield companies start to look more attractive to me because I can't find any targets or any bonds or fixed income assets that is close to this target. So they will start jumping into these markets. So, but I mean, people have been preparing for this because, the Fed's cutting of interest rate has been anticipated for a long period of time. So it's a lot of strategies has been kept on saying that you should buy high dividend yield companies here and there. and it looks like their prediction is now coming to be realized.
So we are speaking with Chen Jiahe, Chief Investment Officer at Novum Archi Technologies, Yan Liang, Professor of Economics, Willamette University, and also Aina Tengen, Senior Fellow at the Taihe Institute. And after a short break, we'll take a look at the latest development in artificial intelligence. Stay with us. You're listening to Biz Today. I'm Zhao Yang in Beijing. ChatGPT creator OpenAI has released a new series of artificial intelligence or AI models designed to spend more time thinking. This is in the hope that generative AI chatbots can provide more accurate responses. The new models, known as OpenAI o1, are designed to tackle complex tasks and solve more challenging problems in science, coding, and mathematics than earlier models. So, Yan, first of all, what are the features of this new series of AI models? And could you help us understand what exactly that is and why we need it?
Right. So this new AI series, AI1, basically it has improved the reasoning and also math skills that potentially it could help, physicists, chemists, or engineers to work out some of the complex problems. It could also help investors to, for example, calculate better their financial trading strategies and also planning. So some of the, the sort of the tests in terms of, for example, math competition or PhD level, science questions. This new series seem to do much better than the ChatGPT 4 or ChatGPT 40. But it doesn't come without, sort of limitations, right? So when it comes to, for example, language tasks like writing, editing, this new series works less good than the large language models like the ChatGPT. Also, it takes significantly more time to answer questions. So what GPT-40 model can answer in 3 seconds, this new model would take 30 seconds to answer the questions. It also works only with text, unlike other AI models. So it cannot handle images, audios, or video inputs and outputs. So again, it has more computational powers to solve some of the more complex reasoning and math questions, but it's not as, I would say, sort of the comprehensive skills as some of the large language models.
And Jiahe, there is also a kind of, emotion AI. The emotion AI, as name suggests, means artificial intelligence that can understand emotion, and more than that, it can respond with emotion. So how much demand is there for this type of technology?
Well, I think that's a very interesting subsector of the AI system because, and that looks like it has got a very large area of application compared with many AIs that we are currently having. For example, the latest version of OpenAI said that they can do a lot of math questions, but human beings can do that too. So you can't really replace a PhD candidate with this OpenAI program. But when you talk about emotional AI, which can recognize how people are, putting emotions on their faces, which include, two parts. One part is, the graphic analysis program that is telling how this face looks like, human face looks like. And the second is the data mining and the calculating program behind that. So both of these combined is enabling these kind of emotional AI to understand people, how people are responding. And that's very important because you can find a lot of real applications for this AI program as long as it can be really accurate. I mean, for example, I don't know how much accurate this program can be right now, maybe 90% or 95%, but that's not enough for application. And if you want to use this in our real life, you need at least 99% or probably 99.9% accuracy. And if an AI program in the future can do this with such a high accuracy of recognizing how people are putting up their emotions. It can be widely used in a lot of service sectors. For example, the receptions in companies, hospitals, receptions in restaurants, receptions in airline companies. They can read your emotions. They can know whether you are not happy with their service, you are very happy with their service. They can get the data set. For example, in a restaurant, you put an AI program and a robot like this in the reception. And when the customers got that food, probably they will not criticize you or praise you if they are not happy or happy, but their emotion can tell you how they are feeling about the food. And this AI program can recognize how people are feeling about this new food, and they can know, the restaurant will be able to know that what kind of service changing they are going to do in the future. So it's a lot of application you can find for this kind of AI program, which is very important for the overall AI industry right now, is that it's not very hard for you to write a program. Well, it's pretty hard, but obviously they have been doing this. So they have got all these programs written, but the problem is that how can they put them into application? How can they make real money out of these programs? This is critical for the AI industry. And when we talk about the emotional AI, probably they can find a very good use of these AI in the real life and make money out of it.
So Anna, what do all this latest development of AI mean for you? The OpenAI O1 and also the emotion AI. And does the public even want AI that understands human emotions?
Well, that's the big question, and I agree with my colleague. Right now, it's a solution, and I mean it has a lot of features, but it doesn't have a lot of solutions. And until it starts making money, there are real questions. I mean, you start looking at the amount of energy that's being consumed. It's more than small countries. Right now, it's at 2% of the world's energy is being consumed by artificial intelligence, and that is going to grow because it's in its infancy. So when you start saying that ramping up more programs, you're going to use more energy.
Well, we're speaking with Ina Tangen, Senior Fellow at the Taihe Institute, and Chen Jiahe, Chief Investment Officer at Novem Archi Technologies, and Yan Liang, Professor of Economics, Willamette University. And that's all the time we have for this edition of Biz Today. I'm Zhao Yang in Beijing. Thank you so much for listening.